Emily Amin, and today we will be reviewing over some different kinds of financial statements and why really understanding this financial information is important to not just only the accounting department, but everyone that works in the accounting firm, all the way to employees, managers, and so really to understand why the financial information is important and a little bit of breakdown on how to understand it when you're not reading it every day. So financial statements, like we just kind of discussed, are very important to many different people throughout a firm or company. A really large part is that they are very important to stakeholders. So people that have invested into the company need to see how it's doing, different ways to gauge the income to taxes. So really being able to allow them to understand the financial information for their firm any further, and to help them manage it. It can also help with decision making, being able to see the numbers and break down, as well as other investment opportunities. It's just very important overall to be able to operate more effectively and efficiently. You really can't. The statement that the truth is in the numbers really shows in financial statements. You can't, manipulate it or try and sweet talk your way out of if your company is doing poorly. You'll be able to look at the numbers and see exactly where it's going wrong, the comparison of previous years, a problem that a lot of owners have is not being very comfortable with the financial statement. When they're actual owners, they tend to have this almost like a blind eye to it. This is their baby, they want it to do well, so they might have this rainbows and butterfly view on how things are, which can actually hurt the company. So being able to have those numbers in front of them, and for them to really take that information, can lead to, if they choose not to and just, my company's doing okay, it'll turn around, it can lead to ineffective decisions and the possibility of failure, which for us, we work here, we don't want that to happen. So for us to be able to understand and read it can help other departments in the company as well. With us being a large company, we have a team that is designated to do this, but you'll find that a lot of companies may not prepare financial statements as often as larger companies do. This can lead to less current information, and the benefit of the information will be decreased because it won't be as up to date or as accurate as doing it every quarter or so really the financial statements, and this is what I really want to share with you guys, is before social media days, the information wasn't as accessible as it is right now. We can check Twitter or even download apps that can kind of give us this information up to date, but that's not always how it is. And also social media can misconstrue the information on one side or the other. So really to have the understanding to break down what is going on in your company, what you're working for. So there's some kind of 4 key financial statements that we'll go over today. The last one, the statement on shareholders' equity, I won't touch on as much because it's not really relevant to you guys, but we'll go over the income statement, the balance sheet, cash flow statement, as well as we'll touch on some financial ratios. So really, why am I sharing this with you guys? What relevance and importance does this have for you? First one, right at the top here, transparency of information. just to be able to know what's going on in the company you work for, how well it's doing, to be able to read that information. It's not just numbers. It's really breaking down how your company is doing, what can be improved, what we're excelling at, what we're not, and really that benefits us in the long term as well. If our company is doing well, we'll see increase in profits. The company will continue to grow, opportunity for advancements, financial benefits to you as well. And also, the finances are really important to customer relationships. We're in this business of transportation, but ultimately we need to make our consumers happy, the other industries that we are transporting to. So really it's overall healthy for the company to be as transparent as possible. You don't want to feel as though they're hiding information from you, which lastly leads to the ethics. You want to feel that your company is honest with you. And having an ethical company, has tons of other benefits that we won't go over today. But, so understanding the different financial statements, how to kind of read them, and just to kind of have a general overview of the company that you're working for. Because the more information that all of the employees are aware of, is the more brains there are, the more that we can catch, if there's mistakes or things that need to be changed. So the first one that we'll go over is a balance sheet. Essentially, what this is a summary of the firm's financial position at a certain time. So the balance sheet goes over balance assets, debts, equity, so words that we're very familiar with, but we need to make sure that we can break it down to read it more clearly. The financial balance sheet really focuses on debt and credit. So credit institutions are very interested in the company's ability to face their debts or their failing due obligations, which ultimately, most companies may have some debts, and that's important for them to see how they will take those on, and how each year, if they repay the credit in advance, or certain situations for investors also to see the real situation of the company. Many companies can use different techniques depending on, a lot of the kind of company it is. So us, we're a, all year transportation, but there are also other companies such as agriculture that only, has a large part of their finances in a certain season. So really it's just at, not from like a full year, it's just from a certain set time that they look at the increase level of cash, the state of liquidity, which is important to investors as well, to really just kind of see. So here on the next page, so you can kind of see it break down from assets, the current assets, the cash, and mostly balance sheets. So the assets and liability are considered short-term because they can become cash or paid off within a year or less. And everything else is kind of considered to be long-term, that will be there. The accounts receivable is the money owed by the customers on credit card sales. You'll also a lot of times see inventory, the cost of goods, prepaid expenses on this one. Property and equipment is also a huge part. Other assets. So it breaks down, the assets on one side, the total of their assets, the liabilities and equity on the other side, the total liabilities, the shareholders' equity, which is still an important part of the company, and then it kind of totals it all up to on each side. So, I mean, you can kind of see it's split literally the name balance sheet, so it kind of balances each cost and breaks it down. The next one we'll go over is an income statement. This one different from balance sheet. From the first one is kind of the date where the balance sheet we went over was at the financial situation at a certain time. Income statements a lot of time have like a year mark. So, I mean, or a certain set period. Most of the time it is a year. You'll hear the word fiscal year a lot. So when we think of year, we think, January 1st to December 31st. A lot of times that's not how companies' income statements are set up. So the fiscal year is, it's kind of their financial year, not typically ending on the 31st and restarting at the beginning of the new year. So being able to understand that can be a setup of it, and to see the dates are thought of a year. So you'll hear the word fiscal year a lot. So to understand what that means, income statements a lot of times are used for management to be able to kind of see, and I'll show you on the next page what they look like. And they're also, there's not just the fiscal year. Those are kind of the large ones that you'll see a lot, but there's also income statements that companies may do monthly or quarterly to see how. So you'll see the next page here, an income statement example. And these aren't our companies. I just found some that were kind of easy to break down and read. So you'll see, the revenues, breakdown, cost of goods, the profits, operating expenses, and then net earning before taxes. There's an income tax expense and the net income. So it has, the sales revenue, the total dollar amount during the set period, to cost of goods. The gross profit is remaining to pay tax costs, and then the net income is income earned after taxes. So that's why it's always kind of at the bottom. So the third financial statement is very useful for planning as well, and you'll kind of find that across the board with some of these is really to be able to plan, to see what kind of the patterns have been where we can choose to change or adjust. So cash flow is useful for planning for the future, to be able to break it down. I mean, when you think of cash flow, it's the movement of money, which is why it's very important to the planning process, to see, I mean, it's the actual cash, the money that you're intaking. So cash is limited in a company, so it's a little easier to read, whereas the balance sheet kind of, you have to jump back and forth, so you can just see the amount of cash in here. So it provides insight as well to operating costs, investments, and marketable security. So you'll just see on the next page, it breaks down the cash flow in different spots. So from operations, from investing, and cash flow from financing. So you can see where the cash is coming in from, adjustments on it. And I mean, cash flow is kind of the main item needed for financing. We are required to report depreciation as well, which is depreciation is the cost of fixed assets that are on annual revenues over a period of time. So you'll see them, across the board from each year, or whenever the statement was time period. It also reduces that income on a firm's report, and we are required by the Internal Revenue Code to deduct those depreciation expenses and report them for tax purposes as well. So cash flow, very straightforward cash that's coming in and out, movement of cash, which is kind of the main goal. We want to make that money. I'm not going to really touch on the shareholders' equity because it's not really relevant information to us. We kind of understand the importance of other investors. But I want to go over financial ratios. We see them a lot, especially in the accounting department. So these are what are actually used for our financial statements. They're important to the shareholders, the creditors, and management as well. So really kind of all the information that we just covered is based on the use of these ratios. And even for myself as management, to use these ratios to monitor our performance from these periods to periods. It's the truth is in the numbers, like we kind of talked about earlier. So it's these set formulas that we can put in for different situations, different financial statements to see is this good? Is this bad? Are we doing well, or is the numbers lower? So really just kind of a cut and dry. We can't, make excuses for it. It shows exactly where we're at. And so to see if we are doing well, by how much. If we're doing poorly, by how much. Excuse me. There are 5 different categories of these. There's liquidity, activity, debt, profitability, and market ratios, which I won't go into today. That would be a whole, another thing that we can definitely go over if anyone has any questions. But just to understand that these ratios are what are kind of used across the board for these financials. So I mean, if you look at it, it's a pretty set breakdown for firms. So of course, different industries will have different ratios, different numbers, but different breakdowns. Sorry, I'm battling a cold here. I thought I'd make it till the end, but so if you will look at the ratios, there's different formulas that each one of these have. I didn't put any examples in here. Like I said, it's just a whole nother section in itself, but you can just see, the ratios on what's low, what's high. You look at Walmart's current ratio compared to, I guess they break down kind of, but just to be able to look at the industries and the companies and see, okay, they're doing better, they're doing lower. From inventory turnover, higher. It's just a very cut down, basically being able to. So it's really kind of what is used. So really kind of the takeaway from today, I know it was a little quick here. I wanted to make it before my voice gave out on me. So the 4 key financial statements that we kind of went over was the income statement, and the income statement was the one that is the dollar amount from the period of time. So it includes the cost of goods sold, the gross profit, net incomes. You kind of think of an income statement with the fiscal year. Second one, cash flow statement, be able to see the cash movement of money coming in, and balance sheet, which has the assets and liabilities, which can be considered short-term, and then everything else, such as liquid, and assets are also, on those balance sheets. I didn't show you guys, but the way that they're set up is that from the most liquid down to the least liquid is how they're kind of laid out. Why this information is important to you to be able to understand is it really is important to know how your company is doing, to be able to read the numbers and see, we're doing good in this, we're doing poorly in this, how can we change? And to be able to process that information into management. For management, we need to be as accountable as well, and to not kind of turn a blind eye to it. And as well as for our customers, we can't lie to them with those financial statements. They, you know, a lot of the information is accessible to everyone, and shareholders as well, to be able to break down and really see how a company is doing, and the ethics behind it. You know, we can't lie with those or alternate them or change them. Not only will that not really profit us, because then when we look back on the next year, you know, and if we start changing these numbers to make ourselves look better, you know, we can't lie. I mean, it's cut and dry. It's black and white. This is why, and this is what the outcome is. We're doing either good or bad, you know, in each situation. And also to be able to see, you know, if we're doing poorly on this, well, let's backtrack. Let's look at, you know, what numbers are lower than last year or last quarter. What's changed? What can we do to kind of improve those numbers? So, and that's kind of all I have. If there's any questions, of course, I'll stick around. Thank you.